I would like to begin by welcoming members to the Pension Fund Investment Subcommittee meeting, including members of the public watching via the Council's YouTube channel and local pension board members observing via Zoom. Please note there is no fire alarm test scheduled for today, so if the alarm sounds, I will adjourn the meeting and we will all make our way downstairs now to the main entrance. The muster point is in the car park. Can I ask, though, that everyone present turns their mobile phones to silent or vibrate whilst the meeting is in place? Could I also ask that everyone speaks clearly to the microphone, just to aid everyone being able to hear clearly what's happening? I'd like to attend a special welcome to Councillor Adela Costello, who is a new member of the committee. Councillor Costello replaces Councillor Ian Gardner. On behalf of the subcommittee, I would like to thank Councillor Gardner for all of his hard work for the pension fund over the years, and welcome. Okay, item 1 on the agenda is apologies and declarations of interest. Dawn, do we have any apologies?
No apologies, Chair. We are missing Councillor Bowden at the moment.
Okay, thank you very much. Does any member wish to declare any disclosable pecuniary interest or non-statutory disclosable interest?
Yep. Sean Walker, retired member of the scheme, daughter and son-in-law, both deferred members.
Thank you. Anyone else? Okay, thank you very much for that. Right, so if we move to item 2, it's the public minutes of the Pension Fund Investment Subcommittee held on the 17th of February 2022. We're being asked to approve this as an accurate record of the subcommittee meeting held on the 17th of February 2022. Can I ask if any member who does not agree with this proposal to raise their hand now? Okay, I see no objections to the proposal to the above minutes as an accurate record, so we will take that as carried unanimously. Thank you. Item 3, the action log. Officers, do you have any comments or updates?
Yes, that's with me. There was 2 items. The first was the climate action plan item, where a member requested information on the progress. That's kind of been superseded now because Chris is going to do a presentation on some passive options later on. So that's, yeah, no longer an ongoing issue, we would say. Secondly, there was just a question around where we were with the equity protection work. So the paperwork is sat in my inbox, so hopefully signed later today or tomorrow, so definitely this week. So it'll all be ready to go with another year. One piece of work we will need to do is to plan to meet you all to explain or give a training session on that equity protection going forward. So we're ready for the next time it comes up, which I believe is in a year, we can decide whether we want to continue with it or not. So that will remain on the action plan.
Thank you for that. Members, any questions on the action log? No, I see nothing. So we are asked to note the action log. Are we all happy to do so? Thank you. Item 4 is Cambridgeshire Pension Fund Investment Monitoring Report, quarter to the 31st of March 2022. Can I ask Chris West to present this report, please?
Great, thank you. So first of all, I'd like to introduce James. So James has been on the Cambridgeshire Pension Fund team for over 3 years now and supports myself and Peter. James will run through the majority of the report, but perhaps beforehand, I'll just give a very brief market background. Clearly, there's lots going on, and there has been lots going on in investment markets over the first quarter of this year. In particular, we started to see in late 2021 was the emergence of inflation coming through, in part driven by some supply chain disruptions, particularly out in China with their zero COVID policy. And what we've seen actually going into the start of 2022 is that inflation environment has really accelerated. So central banks have started to increase interest rates in response to try and temper that inflation. We've also seen clearly the conflict in Ukraine, and that's also had an impact on investment markets. In terms of the direct impact on markets and on the fund in particular, now Russia is a huge country in terms of its size, in terms of its span. Actually, in terms of investment markets, it's not a particularly large country, so the direct impact on investment markets has tended to be small, and that's also the case for the fund. Now, one thing that Russia does have a huge part to play in is it's a large commodity exporter, and we've seen commodity prices increase significantly. The sanctions regime has also hadn't put upward pressure on energy prices, and that's really acted as a catalyst to the inflation that we already started to see at the start of the year. So a very high inflation environment. Now, rising inflation and rising interest rates has tended to put downward pressure on the growth outlook for investment markets, and therefore downward pressure on some asset prices. So not to spoil what James is about to tell you, but you will see some negative numbers come through, and that's as a result of that sort of risk off sentiment in markets, so rising rates, reduced growth outlook. And so perhaps now I'll hand over to James to run through the report.
Yeah, thanks, Chris. So yeah, hi everyone. I'm James. Yeah, so Chris just asked me how long I'd been on Cambridgeshire, and I thought, well, so a year before COVID, that's how we seem to sort of measure things at the moment. So year before COVID, 2 years, so that brings me to 3 years. So just diving right into the report, if you're in the pack, it's page 15. I thought I'd just go quickly through the executive dashboard and then kind of pull out the key areas of the report. So yeah, as Chris pointed out, it's been a tough quarter for investment markets, as probably all quite acutely aware of, and that has fed into some of the numbers. But kind of on the flip side of that, we've had a decrease in the liability value over the quarter. So that's been driven by an increase in yields. So actually what we have seen is an increase in the funding level. So if you flick over to page 17 of the pack, you can see that actually the funding level increased over the quarter, which is clearly good news. And that's just driven by the fact that whilst the assets fell, the liabilities fell to a greater extent. So moving on to allocation. So next page of the pack, page 18. Just kind of pulling out some of the numbers here, you can see in one of the columns, the 31 March 2022 allocation, the equities were overweight their strategic target. So we kind of have a target for where we'd like the assets to sit in percentage terms, and we monitor that within benchmark tolerance ranges. Now, clearly, it's not possible to have it perfect all the time. So if you look at equities, for example, the benchmark was 55% of scheme assets with a tolerance range of 50 to 60%. And if you look, the allocation in percentage terms was 58.3% of scheme assets. That will have come down. So the MSCI World, which is just kind of an index, which is how we would, for how overall equity markets have performed, is down about 12% in US dollar terms from as of Monday this week. So that would have likely have fed through, and kind of the equities would have made up a lower proportion relative to the other assets. If there weren't any questions, I'll move on. Great, so going to flick forward a few slides into the good stuff, into the performance. So page 22. Total plan performance over the quarter was negative 1.3%, and that's benchmarked by, and the benchmark return was negative 1.4%. So despite a negative return, an actual marginal outperformance versus the benchmark. And there were kind of, I won't go down line by line, but I'll at least talk about the equities and the fixed income portfolio. So if we're just looking at that net manager performance table, looking at the first one, Joe Hambro, clearly they've struggled this quarter, return of negative 11.6% versus a benchmark of negative 2.6. So that's clearly quite a material underperformance there. And kind of speaking to Joe Hambro, there are three kind of key drivers for that. The first one being that they're not, as an equity manager, they're not positioned defensively. So given what markets have done, you would expect this sort of performance based on how the manager how Joe Hambro have positioned the portfolio. The second is kind of just a general theme that we're seeing in markets at the moment. So over quarter, value as a style outperformed growth, and Joe Hambro being a growth manager, that impacted them. So just to contrast that, Dodge & Cox below them, who you can see actually outperformed the benchmark, they're a value manager. So that's kind of coming through in the numbers there. And then thirdly, just going back to Joe Hambro, they were underweight energy over the quarter. So underweight energy stocks and overweight technology. Clearly, given what we're all seeing it in our utility bills, I'm sure energy has, that has come through in the numbers. Just stop there quickly in case there are any questions.
So I might just add a point very briefly around the style. So James touched on growth and value. When we think about what growth and value type stocks are, just to put a bit of context around it, so growth stocks tend to be those where the price is largely based on future revenue growth. And so in a growth environment, in a positive growth environment, growth type portfolios are expected to perform strongly. And that's the type of environment that we've seen over recent years with lots of central bank stimulus into markets. The position has turned around in the last 12 months or so. And value stocks are those at the other end of the spectrum that tend to have their price based on current revenues or current profitability or large book price or certain accounting ratios. So more defensive type stocks. And so in the environment that we've seen, which is more defensive in nature, those particular stocks have been valued more by markets. And that's where we've seen that rotation come into a growth value rotation as the market terminology for that. Again, if you look over to the right-hand side of that table, you will see that Joe Hambro, in particular as a growth style manager, their performance has outperformed Dodge & Cox as the value manager, but certainly over the last 12 months or so, that position has started to reverse.
Thanks, Chris. That's helpful clarification. Could you also just comment on maybe the style implications of the Longview portfolio? I know it's been discussed at length over the months and years, but there's quite a strong outperformance there.
Yeah, so Longview have a purported quality bias within their portfolio. Quality is a similar type style to growth. It fits within the growth bucket, so it tends to focus on profitability, but with certain other profitability metrics factored in. So you would expect Longview to perform strongly in a strong growth environment. Now, what we've seen, and it's been reported on regularly over the last sort of 12, 18 months, is that actually Longview's style hasn't necessarily followed a strict quality bias, and they've tended to blend into the value tilt. So, and a style characteristic that wasn't intended when Longview were appointed. Now, actually, I think that's actually been positive news over the recent market environment, because we've seen that rotation. So it's an unintended style bias. It's paid off more recently, so that sort of more defensive positioning that was intended has delivered the outperformance. I think it might be a good time just to mention briefly as well that we've updated our latest quarterly enhanced monitoring on Longview. Again, the performance position there is reassuring and they've also seen a lower level of outflows compared to previous quarters. We do still have some concern around that style positioning, as Sam's mentioned. And in terms of what those concerns are around the outflows, is that there was a potential impact on staff morale. So you may recall from previous meetings that as Longview sees an exodus of cash, the risk is that the staff, their investment professionals, become disenfranchised, and that could lead to potential loss of staff, and that would lead us to have even more serious concerns there. So certainly some reassuring performance figures, reassuring that they've not seen more significant outflows, but still we do have potential concerns there. So the enhanced monitoring should continue.
Members, any other questions at this time? Alan.
Thank you, Chair. It's just trying to get a feel of this. So obviously, you mentioned earlier, the inflationary pressures started in the East and hitting the whole world, and the commodities, certainly with Russia and the volatility. Is it and it might be a naive question, but is it a question by and large of looking at the long-term view and holding your nerve a bit, because some of these markets are so volatile that you've got to look at, as you say, the J.O. Hambro, the 11.6 negative, which but if you look at the 3-4 year, 5 year, then it looks very acceptable. So so from a professional point of view, are you really looking at holding your nerve to a certain extent, because hopefully this is a short-term situation? Say hopefully.
Yeah, I think that's exactly right. And I know that Pete, when he runs through this report, likes to make the point of starting from the right and moving across to the left, because those long-term returns matter more. We certainly shouldn't be overly concerned with quarter-on-quarter performance. You do expect these portfolios to be quite volatile. They're reasonably concentrated. So J.O. Hambro have a portfolio of between 30 and 60 stocks. So the typical weights of each individual stocks are 2 to 3% of the portfolio. So you do expect some short-term deviation. There will be periods of underperformance. So certainly taking a long-term view is appropriate. In terms of how long the inflationary environment could persist, we simply don't know. It depends on a number of factors. So the path of the conflict in Ukraine, that hopefully gets resolved quickly, but it could drag on for a long time. And also the pace of interest rate tightening that we see from central banks. Certainly the markets expect interest rates in the UK to rise to sort of above 2% towards 3% over the next 2 years or so. Now, there are no guarantees that will happen. Interest rates might increase more than what's currently priced into markets, and that could put further downward pressure on asset values. So I couldn't rule out negative figures coming through over the next few quarters as well, if that growth outlook does deteriorate. But certainly over the long run, you would hope and expect that central banks are able to rein in inflation and then hopefully support a more positive growth outlook in future.
Thanks, everyone. So yeah, I've touched on Joe Hambro and Dodge and Cox and in fact Longview. So just then going down, looking at UBS passive equity. So how UBS differ from the other managers above them is that they don't look to seek active returns in markets. They will track the benchmark. And if you kind of look along the numbers, you can see it through there that all they're doing is looking to track the benchmark to gain broad equity market exposure for the fund. And they've done exactly that. So unless there was anything else on the equities, or if Chris had anything to add, we'll kind of move on to the fixed income. Right. So as mentioned earlier, there's been a rise in yields over the quarter, and how that impacts the portfolio is quite a few different ways. The first one, as I mentioned, the fall in liabilities. But what it's also done is, you can see here in the Schroders bond portfolio, that's fed through into negative returns, and that's a function of yields, and to be honest with you, largely expected. So kind of no real concerns there, and note that, as you know, as Councillor Allen mentioned, you kind of have to look a bit further than just over the quarter. So looking over the year, they've returned 1.9%. And then moving on to the multi-asset credit portfolios. So we've got two MAC funds, so multi-asset credit, an abbreviation is MAC. Apologies if I'm slipping into abbreviations, please just stop me if I if I do. But so yeah, we've got these two portfolios, Blue Bay MAC and M&G MAC. And again, kind of similar story to Schroders. They've given what markets have done, have performed largely as expected. M&G are a more defensive manager, so you can see that in the numbers that they haven't performed as poorly or as negatively as Blue Bay. And should also point out that the benchmarks here, what we're using to kind of benchmark these portfolios is a cash benchmark. So Blue Bay would look at just an all-out cash, and then M&G is a cash plus 4 benchmark. So, you know, generally you're not going to get a negative return on cash. So over the shorter term, you might see kind of deviations from the benchmark and a bit more volatility, but over the longer term, you'd expect it to, you know, track a bit more closely. So whilst not in the report, the since inception returns for both Blue Bay and M&G are in the kind of 3 to 3.5% range.
Is it possible to speak to
perhaps just add on multi-asset credit? So it's not a huge universe of managers. And when we look at the relative performance of Blue Bay and M&G across other multi-asset credit managers, actually what we've seen in particular over Q1 is a range of returns from broadly flat, which is as you'll see, M&G slightly underperformed at minus 0.6, but actually some multi-asset credit managers saw drawdowns or negative returns of up to 6%, 7% over Q1. So I think Blue Bay and M&G both held up reasonably well over the quarter relative to the other managers. That negative return again is expected in the market environment that we've seen, in terms of investors maybe taking a slightly more risk-averse approach. Again, as a reminder of what the underlying assets that these multi-asset credit portfolios hold, they tend to be private loans or high-yield bonds, so slightly riskier bonds. So in the environment that we've seen, investors will demand a higher return to take on that risk, which puts downward pressure on the price.
Thank you, Chair. I mean, Mercer, you will recall that one of the objectives of putting in place the MAC fund was to make work credit harder. How would the subcommittee assess whether that objective is being met?
So I guess it comes back to the question around timeframes and allowing the credit mandates almost to see what another sort of market term, but a market cycle. So how this performs in periods when both credit markets have negative returns and have positive returns. When in the environment that we've seen over the last sort of 6-9 months, those negative returns are expected over a market cycle, which has an indeterminate time period, but you could say maybe 3 to 5 years. Looking at the returns over that, say, that 3-year period relative to a low risk bond, so Schroders bond portfolio, you would expect them to add value, because essentially taking slightly more investment risk in order to get more investment return relative to those low risk bonds.
Thanks, Chris. So the last, I'm going to kind of finish off here and go through the alternatives portfolio. So what we've got here is, if you're on page 23, you kind of read down, and there's property in there, residential property, private equity, infrastructure. So all fall under the bucket of what we would classify as alternative investments. What I will say just right off the bat is that there's some quite wacky numbers in here. Just to pull one out, one that jumps out to me, you look at the Harbour Best private equity portfolio over the year, returned 70% versus benchmark of 20%, which is quite impressive. But just to sort of put it into a bit more context, these don't make up a massive proportion of the overall portfolio. So if you jump back and look in the allocation pages, you kind of look at them, and UBS infrastructure, for example, is only 0.2% of the portfolio. Partners infrastructure is 1.2%. So kind of the objective here is to have a well diversified portfolio across a number of asset classes and a number of mandates. So just if I start at the top, I won't go through all of these, but it's been a strong environment for property recently, so that's performed relatively well. And then jumping down the page, if we look at two of the relatively new mandates we've had, so the bottom two lines, IFM infrastructure and JP Morgan infrastructure equity. So IFM is relative to JP Morgan is riskier, and that's come through in the numbers, that they've returned slightly more over the quarter, and then indeed over the year as well. So I didn't really have anything else to add on these, unless there were any, happy to take any questions, or I think Chris has something to.
Yes, I was just going to make the point around alternatives in general, which of these tend to be focused on privately held assets. Now, the previous page, when we look at the listed equity portfolio and the fixed income portfolio, these are predominantly listed assets. So they're traded on exchanges, they're traded daily. So the prices move around almost on a constant basis to reflect market sentiment. Whereas actually this page focuses on the likes of privately held property, and we'll hear from Schroders today, and private equity investment, so stakes in privately held companies and infrastructure. So the pricing tends to be less volatile. So you tend to certainly see trends come through in those longer term returns again, which is the theme today, but the focus here is on the longer term returns than the quarter by quarter. Property in particular at the top, and I'll touch on this when we provide a brief update before Schroders present. We've seen a very strong 1 year return there for property, and that reflects the bounce back in property markets. There was a severe slowdown in property markets during COVID. Lots of uncertainty around the future of the office sector, for example. Retail was hit hard. So that's had a very strong year. Whereas M&G's residential and shared ownership mandates are slightly more income focused. So they focus on residential property. More of the return comes through in the rent. And so again, you would expect those returns to be lower than Schroders core property. So no concerns there that sort of their return of 4.4% over the year, for example, lags the close to 18% return that Schroders have delivered. That's largely a function of the type of property assets that they hold.
Thank you. Members, any questions, comments? I could just make one point then. Obviously, we're seeing some unfortunately negative figures in here, but the advice that we're receiving then is that at this stage we should be holding our nerve and waiting, because we expect markets to revert at some point in the future.
Yes, I mean, the pension fund is a long-term investor with a long-term investment horizon. I think you're entirely right. It has a long stream of liabilities years into the future. So actually tracking investment performance, first of all, against the value of those liabilities, which has been positive over the quarter. So that's positive news despite the negative numbers. And secondly, yes, investing in these asset classes, particularly the alternatives and equities, you need to have a long-term investment horizon. You will see short-term blips in markets, and that's certainly what we see now. And the expectation is that if the world continues to function and investment markets continue to function as you would expect them to, that you will see growth come back in and positive returns in future.
Thank you for that. Okay, members, we are asked to note the report. I trust we're all happy to do so. Thank you very much. Okay, the following items on the agenda are exempt from publication, so the subcommittee will need to decide whether to exclude the public and press from consideration of the following items on the grounds that the reports contain exempt information under paragraph 3 of part 1 of Schedule 12A of the Local Government Act 1972, as amended, and that it would not be in the public interest for this information to be disclosed, information relating to the financial or business affairs of any particular person, including the authority holding that information. May I ask if there is general consensus in support of the recommendation